Core inflation in Japan rises to 2.4% in December. China revises 2023 GDP upward by 2.7%, bringing it to 129.4 trillion yuan. And Saudi Arabia provides $500 million to Yemen's government to cover salaries and other expenses. Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on the latest economic trends and developments. Welcome back. We start off with Asia, where Japanese government data has shown that core inflation in Tokyo rose to 2.4% in December, up from 2.2% in November, driven by higher utility bills and food prices. However, inflation, excluding fresh food and fuel, a measure closely monitored by the Bank of Japan, eased slightly to 1.8% from 1.9%. Service sector prices increased 1% year-on-year, reflecting rising wages and strengthening demand, a development seen as supportive of the BOJ's inflation target. Policymakers will assess these trends at the upcoming Jan 23 to 24 meeting, with some analysts expecting a short-term interest rate hike. Moreover, Japan's industrial output fell 2.3% in November compared to October, marking its first decline in 3 months. Preliminary data from the Ministry of Economy, Trade and Industry showed that the seasonally adjusted production index stood at 101.7, following a revised 2.8% rise in October. The decline was driven by weaker exports of semiconductor manufacturing devices and cars. The Bank of Japan has released its first ever estimates on the financial impact of future interest rate hikes, revealing potential annual losses of up to 2 trillion yen in fiscal years 2027 and 2028 if short-term borrowing costs rise to 2%. The estimates reflect the BOJ's commitment to gradually raising rates to neutral levels in the coming years. The analysis considers scenarios where short-term rates increase to 1 to 2%, with spreads between short and long-term rates ranging from 0.25 to 0.75 percentage points. Losses are expected to decrease starting in fiscal 2031 as the bank's earnings recover. The bank ended its decade-long ultra-loose monetary policy in March, raising short-term rates to 0.25% in July. In China, the National Bureau of Statistics has stated that the country's industrial profits fell 7.3% year-on-year in November, slowing from October's 10% drop. Despite the improved monthly figures, 2023 is said to mark the steepest annual profit decline in over 2 decades due to weak domestic consumption. Economists noted that recent government stimulus measures have started to show some positive effects, reflected in the slower profit decline and a less sharp drop in factory gate prices. The producer price index fell 2.5% year-on-year in November, improving from October's 2.9% contraction. China's National Bureau of Statistics has revised the 2023 GDP upward by 2.7%, bringing it to 129.4 trillion yuan. Kang Yi, head of the bureau, stated that China's economy has withstood the test of multiple internal and external risks over the past 5 years and maintained a generally stable trend while progressing. Despite this adjustment, officials anticipate a minimal impact on the projected 2024 growth rate of around 5%. The revision follows the fifth national economic consensus, reflecting China's resilience amid recent challenges. China attributed its upward revision for 2023 gross domestic product to changes in housing sector calculation methods, which would also affect the size of the economy in 2024, but have little impact on the growth rate. The adjustment stems from changes in the housing sector calculation method, adding 1.34 trillion yuan to housing services contribution. The National Bureau of Statistics stated that while the revision affects the economy size in 2024, it has little impact on the growth rate. The share of tertiary industries, including retail, finance, and property, rose to 56.3% of GDP, contributing to the revised total. Still in China, the National Bureau of Statistics has released the outcomes of its fifth national economic consensus, showing significant growth in the country's secondary and tertiary industries. By the end of 2023, there were 33.27 million legal entities in these sectors, a 52.7% increase from 2018. Additionally, self-employed businesses grew by 39.8%, reaching 87.995 million. The top three sectors by the number of entities were wholesale and retail, leasing and business services, and manufacturing, with wholesale and retail making up 30.6% of the total. Geographically, the eastern region held 53.9% of legal entities, while the central and western regions saw growth in their shares. The World Bank has raised its forecast for China's economic growth, projecting 4.9% in 2024 and 4.5% in 2025, citing the impact of policy easing and strong exports. However, it warned that challenges like subdued household and business confidence, a struggling property sector, and an anticipated U.S. tariff hike could weigh on recovery efforts. Mara Warwick, the World Bank's country director for China, said that addressing challenges in the property sector, strengthening social safety nets, improving government finances will be essential to unlocking a sustained recovery. Joining us from Dubai is economic and legal expert Ayman Ghunaim to discuss the latest developments in the Chinese economy. Dr. Ayman, thank you so much for joining us on the Economic Bulletin. And first off, what does the upward revision of China's GDP by 2.7% for 2023 signify for its economic resilience and reporting transparency?
Well, actually, we know that the Chinese economy is the second largest in the world after the United States. That's in terms of the annual nominal GDP. In 2024, it's estimated that the United States of America will close the year with a nominal gross domestic product of around $29 billion, while China would close the year with around $18.2 billion. So it's the second in the world, and it can be considered also the third in the world if we consider the EU as one block. So the European Union will close the year with around $19 billion US dollars. So China is, of course, is a major economy in the world, the second or the third, as we said, and it's one of the major forces that affect the demand for goods and services in the world. Of course, China did suffer from its real estate crisis since 2020, and presently China is trying to move on and is trying to boost its economy and boost its growth. And we've seen the promises of the Chinese government and the Chinese central bank to adopt a more expansionary economic policy to ease its money supply, to increase its money supply, to push down interest rates.
Now, Dr. Ayman, with the World Bank revising China's growth to 4.9% in 2023 and 4.5% in 2024, how effective are current policy stimulus?
Well, we know that the Chinese government has a growth target of 5%. Of course, China did have a double-digit growth in GDP in the previous decade, especially in late 1990s and early 2000s. It's apparent that the international business community do trust China and do trust the resilience of the Chinese economy and the impact of the easing economic policy and the impact of the stimulating package that the Chinese government intends to effect. And this trust, we can ascribe it to many factors. Of course, the resilience of the Chinese manufacturing sector, the resilience of the Chinese economic structure, ability of China to produce and to export, and the high productivity of the Chinese sectors of production. Of course, China did suffer not only from the real estate crisis, but also since 2020 from COVID-19 and the severance of many of the supply chains, and then came the Russia-Ukraine war and its spillovers all over the world, especially the increase in oil prices and the inflation. It added to the Chinese problems. But what I want to say here is that the growth of China is a very important factor in the world economy, and the reduction or the sluggish economy, or we can say the reduction in the rate of growth in China because of the COVID-19 and then because of the real estate crisis was one of the challenges in the world economy during the last 3 to 4 years. So now with the revision in the World Bank's expectations regarding the Chinese growth, it's expected that there should be a wave of optimism in the whole world economy, and this would increase the trust of both the consumers and the investors worldwide.
Now, Dr. Ayman, regarding China's goal of doubling the economy by 2035, can it realistically achieve this goal given the need for 4.7% average annual growth?
Well, so far, China can do it because it's annual, as you said, its annual growth target is 5%, and presently the World Bank did revise the Chinese growth expectations to 4.9%. Of course, it's challenging because China still suffers from challenges in its real estate sector, in the valuation of the real estate prices. And we have to remember that one of the reasons, or one of the forces behind the double-digit growth during the late 1990s and the early 2000s in the Chinese economy, in its real GDP, was its sustainable or sustaining real estate sector. So the real estate sector in China, especially in the major towns, the major cities, remains to be one of the factors that would affect such the achieving of such goals. But here, what I'd like to assert on is that the stimulations and the stimulating packages enacted either through the fiscal policy or the monetary policy of China, those stimulations are expected to yield good growth and to yield good results. And that's again because of the resilience of the production sector in China, its dynamic production structures and its ability to absorb shocks, especially shocks in the increasing costs, especially shocks in increasing prices of different sectors of production. China is able to absorb such shocks and is able to produce and to export. I believe this would be the major role, and also the role of the research and development in the Chinese manufacturing companies. China was able to accumulate a lot of wealth during the previous decades, and it was able to invest a good portion of such wealth in research and development, especially in the efficiency.
Thank you so much, Mr. Ayman Ghunem, for your insights. Sorry for interrupting you due to the shortage of time. Thank you so much for all the information. Now back to our news. The statistical agency Rosstat has reported that Russia's inflation reached 9.5% this year, with the consumer price index rising by 0.33% in the week ending December 23rd. This follows the central bank's unexpected decision to keep its key interest rate at 21%, aiming to bring inflation down to its 4% target. Seasonal factors, particularly rising fruit and vegetable prices, contributed to the increase. The central bank had initially forecast inflation at a maximum of 8.5% for the year, but the head of its monetary policy department now expects inflation to close between 9.6% and 9.8%. India's Finance Ministry's November report expects the country's economy to grow around 6.5% in 2024 to 25 fiscal year, aligning with the lower end of its 6.5% to 7% target. The report showed that while rural and urban demand showed resilience in the October to December period, global uncertainties are weighing on growth prospects. Economic expansion slowed in July to September, driven by weaker manufacturing and consumption. However, the second half of the fiscal year is expected to outperform the first. Reuters reports that India may reduce income tax for individuals earning up to 1.5 million Indian rupees annually in the February 2024 budget, aiming to support the middle class and boost consumption as economic growth slows. The proposal, benefiting millions of taxpayers, particularly urban residents burdened by high living costs, would apply under the 2020 tax system. This framework levies rates between 5% and 20% for incomes between 300,000 Indian rupees and 1.5 million Indian rupees, but excludes exemptions like housing rentals. Higher incomes face a 30% rate. Turkey's central bank lowered its key interest rate by 250 basis points to 47.5%, initiating an easing cycle aimed at tackling prolonged economic challenges and high living costs. This decision follows an 18-month tightening effort and signals a shift towards more orthodox policies supported by President Erdogan. Annual inflation dipped to 47% in November, and the central bank anticipates further reductions towards its 5% inflation target over the next few years. The rate cut triggered a brief dip in the Turkish lira to an all-time low of 35.30, though it later recovered. The number of Americans filing new applications for jobless benefits dipped to its lowest level in a month, reflecting a cooling but still healthy U.S. labor market. The U.S. Labor Department reported that initial claims for state unemployment benefits fell by 1,000 to a seasonally adjusted 219,000 for the week ending December 21st. However, the number of people receiving benefits after an initial week of aid, often seen as a proxy for hiring, rose by 46,000 to a seasonally adjusted 1.910 million during the week ending December 14th, marking the highest level since November 2021. The Central Bank of Egypt maintained its key targets, with the overnight deposit rate at 27.25%, lending rate at 28.25%, and the main operation rate steady at 27.75%. The credit and discount rate also remains at 27.75%. The Monetary Policy Committee adjusted inflation targets to 7%, positive or negative 2% by the fourth quarter of 2026, and 5% positive or negative 2% by quarter 4 2028, advancing towards a comprehensive inflation targeting framework. Preliminary data for late 2024 show Egypt's GDP growth outpacing quarter 2, but still below full potential, supporting further inflation declines into 2025. Wage-induced inflation remains minimal amid subdued real wage growth. Egypt and Thailand have signed a memorandum of understanding to establish a joint trade committee and an economic cooperation action plan. Held virtually, the signing aims to boost Egypt's economy, attract foreign investments, and facilitate trade. The action plan outlines priority areas for collaboration, with the first joint trade committee meeting proposed for the first half of 2025. Egypt's investment minister Hassan al-Khatib highlighted Egypt's vision to become a regional hub for investment and trade by fostering an investment-friendly environment and streamlining customs clearance to 2 days by 2025. A Saudi official has announced that his country will provide $500 million to Yemen's government to cover salaries and other expenses. This is part of the $1.2 billion approved last year to support Yemen's government, displaced by Houthis since 2014. The funding, aimed at addressing Yemen's budget deficit, follows previous payments of $250 million in February and August 2023. The official stated that the funds will support salaries, operational costs, food security, and economic reforms, underscoring Saudi Arabia's commitment to Yemen's stability. In commodities, oil rose almost 1% on Friday and was on track for a weekly gain, spurred by expectations of a stimulus-driven economic recovery in China, the world's biggest oil importer, and by forecast of lower U.S. inventories. Brent futures included up 0.1% to $74 a barrel, while U.S. West Texas Intermediate crude rose 1.1% to $70.40 a barrel. For the week, Brent and WTI were up 1.5% and 1.4% respectively. Gold prices eased on Friday, but were set for a weekly gain as investors gravitated towards safe haven assets amid political uncertainty in the Middle East, overshadowing pressure from a firmer dollar. Spot gold was down 0.3% to $2,626.52 per ounce. Bullion has gained 0.2% so far this week. U.S. gold futures fell 0.5% at $2,642. That's all for now. Here's a roundup of today's key headlines. Core inflation in Japan rises to 2.4% in December. China revises 2023 GDP upward by 2.7%, bringing it to 129.4 trillion yuan. And Saudi Arabia provides $500 million to Yemen's government to cover salaries and other expenses. That's all for today's economic bulletin on Q News. Stay connected for more news and updates, and thank you so much for watching.